What's up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. If you're new to the channel, we focus on the stock market here, primarily with a focus on the Canadian markets. And this week, we're going to be diverting from what we usually do, which is individual stock analysis, and instead bring you something that has been in very high demand recently, and that is ETFs. Over the next few weeks, I'm going to put out a bunch of ETF videos. I'm going to go over some dividend ETFs, REIT ETFs, tech ETFs, growth ETFs, anything that I can think of that I can put together in a valuable video. So this week, we're going to tackle one of the most important ones and probably one of the most popular ones, and that is dividend ETFs. I have 5 of the best dividend ETFs in the country, and I'm going to bring them to you in this video, so let's go. So here in Canada, our dividend payers are primarily focused in the financial sector and the oil and gas sector. So as a result, these dividend ETFs have struggled quite a bit in 2020 and moving forward in 2021 when we look at the broad scope of the market. But these are still very solid dividend ETFs, and they can give you essentially one-click exposure to the whole country. But the one thing you do have to watch is if you are purchasing multiple dividend ETFs here in Canada, there is some situations where you might be doubling up on holdings and not even knowing. This is because, as I said, a lot of these dividend ETFs contain a lot of financial stocks. Numerous ones, the top 10 holdings will be very similar. So I'm going to try and get a different mix of ETFs in this video. The first one we're going to start with is Horizon's Active Dividend ETF. It trades under the ticker HAL.TO on the TSX. So the number one reason we wanted to bring HAL to your attention is the fact that this is a very rare ETF, a dividend ETF here in Canada that isn't dominated by financials. And if we look to its top 10 holdings, we'll actually see that a tech stock, OpenText, is the number one holding, Royal Bank being the second, and then we go back to another dividend growth tech stock in Enghouse, Constellation Software, Capital Power, WSP Global. You can see that essentially there's only 2 financial stocks in the top 10 holdings. And with it having only 77 million in net assets, this is a smaller ETF, but it is one that provides a pretty reasonable return and a pretty high dividend for investors. So since inception in 2010, HAL has provided an 8.89 annualized return to Canadian investors. And if we look to the ETF's chart since inception, we can see that this ETF has outperformed the TSX index extensively. Over the last 10, 11 years, this ETF has returned 141.4%, while the TSX has returned just shy of 60. So this is an ETF that has not only provided consistent dividend returns to Canadians, but it's also outperformed the broader market, which is pretty difficult to say in the COVID era, especially with these dividend ETFs, because of their reliance on pipelines, oil and gas, and financial companies. So this ETF is actively managed, which means it does have a little higher fees than usual. You're going to pay 0.55%, or essentially $5.50 for every $1,000 invested. But considering the outperformance of the ETF compared to the TSX, this is a fairly appropriate fee. And another thing about this ETF is it does have some exposure to the United States. Yes, 95% of holdings are Canadian listed companies, but 5% are companies trading down south. And if we go back to the holdings, we can see that this is actually a relatively evenly weighted ETF as well, with the top 10 holdings accounting for only 38.85% of total assets. And the biggest holding is OpenText at 4.87. What they're aiming for in this ETF is for no holding to take up more than 5%. Overall, you can see a lot of tech exposure, especially high dividend growth companies in the tech industry are 2 dividend aristocrats in Enghouse and OpenText. And this has less of a reliance on oil and gas and financials. So overall, this might be the most well-balanced dividend ETF here in Canada. It has a yield of around 3.85%, so it is one of the lowest yielding ETFs, which is why I wanted to speak on it first. But overall, I don't think you're going to go wrong getting one-click exposure to essentially the whole Canadian economy with HAL. But let's move on to the next Canadian Dividend ETF, and that is ZDV, or the BMO Canadian Dividend ETF. So one thing we can notice about ZDV immediately is that it yields quite a bit more than HAL. It yields around 4.76%, and this is primarily because this ETF does contain large exposure to both oil and gas and financials, which have had their prices beaten down because of the COVID-19 pandemic. And as you know, when stock price goes down, yield goes up. So if we look to the top 10 holdings of this ETF, we can see that the number one holding is arguably Canada's most popular pipeline, and that is Enbridge. And if we move forward down the holdings, we can see that the Bank of Nova Scotia, the Royal Bank of Canada, the Toronto Dominion Bank, the Canadian Imperial Bank of Commerce, and the Bank of Montreal are all inside this portfolio. So a very heavy weighting to Canada's big five banks. And then if we look to Enbridge and TC Energy, as well as TELUS and BCE, we can see that the top 10 holdings in this ETF are essentially all centered around Canada's most critical industries, being the telecom, the pipeline, and the financial sector. These industries are known for paying high yielding dividends, and as a result, ZDV does provide a nice yield. So the ETF has net assets of $549 million and does pay a monthly distribution. So it is important to note that this ETF is actively managed and it aims to target high yielding stocks. So as a result, it's likely going to be more volatile than most. Management fees come in at around 0.35%, so you're going to be paying $3.50 for every $1,000 invested. And this ETF does track the overall weightings of the TSX index pretty accurately. It contains 39% financials and around 13% oil and gas in terms of overall holdings. So very financial sector focused. And as we spoke about with the top 10 holdings, even though this ETF aims to have a particular stock not make up over 5.5%, there is a very heavy focus on 10 companies here in Canada from Canada's strongest industries, and especially a very heavy Big Five bank presence. So if we look to the ETF's chart, we can see that it's returned 49.4% over the last 5 years, while the TSX has returned around 43.7%. But the key thing to note is that this ETF was outperforming the TSX index by quite a large margin before the COVID-19 crash. And this does make sense as the crash has heavily impacted financials and oil and gas. And as we see on the chart here, right before the pandemic, this ETF was outperforming the TSX by a pretty close to 20%. So it was a very strong performer. Now, with its extensive weighting to oil and gas and financials, it's difficult to say how ZDV will perform moving forward. But Canada's financial sector has continued to prove us wrong in the pandemic, and it's very possible that it could continue to prove us wrong moving forward. The only reason I believe that big five banks aren't raising dividends right now and major insurance players is because they're being forced not to. I really feel that these companies are in a financial position that they would be raising dividends if allowed. So it'll be interesting to see how ZDV does, but it's definitely a dividend ETF that you want to put on your watch list. And moving forward, our next dividend ETF is going to be arguably the most popular Canadian dividend ETF, and that is because it follows the Canadian Dividend Aristocrats Index, and that is CDZ. So just a quick pause from the video. If you like the video, smash that like button, hit that subscribe button. It really helps us produce more content. And let us know in the comments below if you like us focusing on ETFs for a bit, or if you'd rather us stick to individual stocks. We like ETFs. I invest in them myself, not for Canadian stocks, but particularly to gain international exposure. And I feel they provide a pretty good opportunity for any investor to get single-click diversification. And one more note on the premium end, we did actually end up launching our Discord server last week with massive success. So if you want to check out Stocktrades Premium, you can get started for free down below. You'll get 3 of our foundational stock picks absolutely free, a ton of custom reports that we develop for premium members that we've offered to you absolutely free on popular companies like Dye & Durham, Acuity Ads. There's a ton of content in there that's absolutely free. So again, in the description, you can sign up for free. But with that being said, let's get back to more ETFs. So an interesting note about CDZ, it is the only ETF that gives you exposure to exclusively Canadian Dividend Aristocrats. Comparatively, down south in the United States, there is over 10 ETFs that track the US Dividend Aristocrats. Now, there is a big difference between the two. A Dividend Aristocrat in the States is 25 plus years. We have less stringent requirements here. It's only 5 years of consistent growth. And actually, a company can miss a year of growth and keep the dividend steady and still be classified as a Canadian Dividend Aristocrat. But regardless, this ETF is going to give you exposure to all of the Canadian Dividend Aristocrats. And if we look to its top 10 holdings, we can see that this ETF has a very large focus on pipelines. You can see that Keyera, Enbridge, Pembina, and TC Energy are all in the top 10 holdings, with Keyera, Enbridge, and Pembina making up the top 3. Now, this whole ETF is all relatively evenly weighted, as you can see with Keyera only making up 2.83% of holdings, but the pipeline focus in the top 10 is something that investors need to keep an eye on. And if we look to other holdings, we can see that SmartCentres Real Estate is the biggest REIT in this portfolio, and it is a commercial REIT that has been impacted extensively by the pandemic. We can see that there is a good mix of holdings in this top 10, including a company like Exchange Income Corp, a telecom like BCE, a utility company like Capital Power, an insurance company like Power Corporation. So this ETF does have a pretty nice makeup. So to be included, the stock has to have a market cap of at least 500 million, and currently there are around 82 holdings. The ETF yields just under 4%, and it has a 10-year return of 6.43% annually. So this is an ETF that has struggled in terms of overall returns, but it still has, on a dividend adjusted basis, outperformed the TSX. If we look to its 5-year chart, it has returned 54.8%, while the TSX has returned 43.7%. So this is also a very well-balanced ETF, and the only sector that accounts for more than 20% in terms of overall holdings is financials. The other sectors account for around 7 to 17% each. So you're not getting the extensive financial exposure like ZDV has. You're getting a more well-rounded ETF, which contains companies in the renewable energy sector, like, say, Intergex Renewables, TransAlta Renewables, companies like that. So this is really a broad-based ETF that provides you with some pretty solid exposure to Canadian companies that are consistently raising dividends. It has fees of around 0.6%, so you're going to pay $6 for every 1,000 invested. So this is a great option for Canadian investors looking for a wider variety of stocks. This is probably the most well-balanced Canadian dividend ETF. And with that being said, let's move on to our next one, which is the iShares variant of the High Dividend ETF, and that is XEI. So if you're looking for a monthly distribution and a high yield, XEI is likely going to be your favorite dividend ETF on this list. That is because it is yielding just shy of 5.2%, and it also has extremely low fees when compared to the other ETFs. This dividend ETF is only going to cost you $2 annually per every 1,000 invested, with management fees of 0.2%. And this ETF does also shift back to a focus more on Canadian financials, oil and gas, and telecom. If we look to its top 10 holdings, we can see that Toronto Dominion Bank, one of our favorite Canadian banks, is the number one holding. And then we have Enbridge, Royal Bank of Canada, Bank of Nova Scotia, Canadian Natural Resources. We see again Nutrien, BCE, TELUS, Suncor. So this ETF does have more of a focus on energy and financials. But we can see that unlike the previous high dividend ETF, this does not contain all of Canada's big five banks. So this ETF has more of a focus on oil producers as well. It skips out on Bank of Montreal and Canadian Imperial Bank of Commerce, and it instead adds in producers like Canadian Natural Resources and Suncor Energy. Now, one thing I'm not particularly a fan of is the fact that Suncor remains such a high holding in this ETF despite it cutting its dividend. Canadian Natural, I have no problem with. It is best in class, but as a current shareholder, I was pretty soured when Suncor cut their dividend so quickly into the pandemic. But technically, it still is a high-yielding stock, so it still has a place in the top 10. So this ETF aims to track the High Dividend Index, which is essentially 50 to 75 stocks that are selected based on yield. It aims to not have a particular stock take up more than 5% of holdings. So if you can tell by the holdings we looked at, it probably needs some rebalancing as a couple do make up over 5%. Of note, it can also not contain more than 30% exposure to a particular sector. So if we look to the overall performance of XEI, we can see that it has returned over the last 5 years 50.9% on a dividend adjusted basis, while again the TSX has returned 43.7%. So this is another dividend ETF that has outperformed the index, and on an annualized return over the last 5 years, it's returned about 7.27%. Now, if you're looking for diversification, this is definitely not the ETF for you, because the top 10 holdings make up nearly 50% of this ETF overall. If we look to our previous ETF, the Dividend Aristocrats ETF, the top 10 holdings only make up 23.9%. So this is very heavily weighted towards the top stocks in this ETF. And that is one of the primary reasons why it yields north of 5%. Now, there is a chance that this ETF could underperform moving forward if the negative sentiment towards oil and gas, pipelines, and producers does not go away because of the heavy exposure in the top 10. But if we do see a rebound in that area, we could see this ETF outperform moving forward. It's one that you should definitely add to your watch list regardless. But moving on to our last dividend ETF here in Canada is the iShares Canadian Select ETF. It trades under the ticker XDV. So XDV is unique in the way that it aims to track the 30 highest yielding dividend paying companies on the Dow Jones Canada Total Market Index. So Dow Jones essentially uses a rules-based methodology to select the top stocks in this ETF. And if we look towards its holdings, we can see that this ETF has a laser focus on Canada's big banks. We can see the Canadian Imperial Bank of Commerce is the number one holding at a whopping 8.54%. The Bank of Montreal, the Royal Bank of Canada, the Bank of Nova Scotia, Toronto Dominion Bank, and for the first time in this video, we're seeing, in our opinion, one of the best banks in the country, National Bank. So we can see that the big five banks all have relatively high weightings, and we can see snuck in here is Canadian Tire. They're actually the second largest holding in this ETF at 8.21%. And this is also the first time we've seen the Canadian retail giant in one of these ETFs. Of note, Genworth MI was acquired by Brookfield, so this overall holdings is likely to change, and we see major telecoms like BCE and TC Energy a major pipeline. So with this dividend ETF having 1.36 billion in net assets, it is the largest on this list, and it is one of the larger dividend ETFs in Canada. It yields around 4.79%, so not as much as XEI, but we have to consider the fact that XEI does laser focus in on high yielding companies. Management fees of 0.55% means you're paying around $5.50 for every $1,000 invested. If we look to overall returns, this has actually been one of the better performing dividend ETFs on this list. Actually, it is second only to our first ETF, which would be HAL. As we can see by the chart, it's returned around 52.5% over the last 5 years, while the TSX has returned 43.7%. So in 2020, the fund did underperform the TSX, and over the last 3 years, it has relatively stayed even with the TSX. But if we look to 5 and 10 years, that's when it truly started to outperform. Now, I can't stress enough that an investment in this dividend ETF is essentially a massive play to the Canadian financial sector. And this is because, as we can see in the holdings, this has no weighting cap on any particular stock, and it also has no weighting cap on any particular sector. So this ETF contains over 60% exposure to Canadian financials. There's no other sector in this ETF that contains even double digits in terms of overall allocation. In fact, the next closest sector allocation is utilities at 9.85%. And the top 10 holdings of this ETF make up over 55% of the overall ETF. So this is a very, very financial focused ETF, and you need to know this before purchasing. Don't just go in blindly and purchase this ETF because of its outperforming returns and its high yield. You really need to check the overall holdings. But if you are looking for something that is laser focused on Canadian financials, I don't think you would find a better dividend ETF on the market right now, except for maybe some covered call bank ETFs that skip everything else and just focus on the 6 banks. So that's it for the video, everybody. I really hope you enjoyed it. 5 popular Canadian dividend ETFs, ones that can provide you with strong monthly distributions, some of them even yielding over 5%. We plan to bring more ETF videos your way, but that's only if you let us know if you enjoy them or not. We want to make content that you want to watch. So drop a comment down below. Let us know if you like this or if you'd like us to stick to individual stocks. Smash that like button, and most importantly, subscribe to the channel. We're producing 3+ videos a week at this pace we're going right now, so it's really important that you subscribe to get the latest alerts, and I'll see you next time.